Excel accounting practice problem. Make amortization table. Get ready because we're about to excel. Here we are in our Excel worksheet. In prior presentations, we put together the worksheet from a blank sheet. Now we're continuing to enter transactions into it. If you have access to it, there's two tabs on down below, the example tab and the practice tab. The practice tab starting out where we left off last time, the example tab in essence being an answer key. Let's take a look at it now. So now we're going to be putting transactions in place related to the paying off of the loan payable. To do that properly, we need to then allocate out the interest and the principal. To do that, we're going to need an amortization schedule. So we're going to go all the way to the right and construct an amortization schedule, which is going to be way out here looking something like this, which we will then use to record our transactions related to it. Let's go to the practice tab and do that. Let's go to the practice tab. We're going to go all the way to the right before we get to then the financial statements, the balance sheet, and we're going to put in place there this amortization table. So we're scrolling all the way to the right. There's a lot of stuff these days in this worksheet. And so we're going to put it right in between the EO and the EQ. So I'm going to put my cursor on the skinny right here, and I'm going to go all the way to the right, and then I'm going to insert some cells in here. Right click and insert. That should be more than enough. And then let's remove the formatting and let's do our own formatting. I want my own formatting in there. Right click and format these cells. And we're going to make the format to be, it froze. It frozes. Then we're going to say this is going to be the number. Let's make it currency. And I'm sorry, currency, brackets, no dollar sign. Remove the decimals. That looks good. Okay. We'll then make it all bolded as well. Let's make this a skinny column, and let's see if I can copy the width of this skinny. So I'm going to take that skinny and paintbrush it and make it that skinny. So there we have it. So this is going to be our amortization table. I'm just going to put my data on the left. So we're going to say the loan is for $72,000. And I know we put two transactions into that loan, but this is just going to be an example of the loans payable that we're going to just say it's $72,000 here. We're going to say the years are, it's going to be a 5-year loan. So the months, we're going to say we pay it on a monthly basis. So if it's 5 years, then it would be 5 times 12 or 60 months. The rate, we're just going to say is 5%, 0.05. We're going to make that a percent in that column by going to the Home tab, number group, percentifying it. And then we'll go down to the payment. Payment is going to be, we'll calculate the payment. So based on this information, we will calculate the payment, which is something you might get from the loan place. But if you're kind of estimating your loans, this is one way you can calculate the payment. It would be this formula, negative PMT. Shift 9, so this is the payment formula. The rate is in that cell. It's going to be the 5% in ER4. And I know I'm doing this quick because this is really a bookkeeping problem, not really a finance kind of thing where we do these amortization tables, but it could be a useful skill. So we'll put this in place and we will need it to do the bookkeeping with regards to the amortization schedule. So we'll take the rate. That's a yearly rate. We're going to divide it by 12 to get the monthly rate, comma. Number of periods is going to be, we could say 5 years times 12, or the 60 months that we have already put in place, which is ER3, comma, the present value is the loan amount of the $72,000. The negative instead of the equal sign will flip the sign, so it'll be a positive number, closing up the brackets and enter. We get the 1359. If we add some pennies to it, we're actually talking 1358.73. I'm going to take the pennies off, however, and we'll keep it kind of rounded, our rounding scenario we've got here. Let's make this column a little bit skinnier. We don't need to make it as skinny as all the skinnies, but we'll make it a little skinnier. And then we'll put our headers for our amortization table. Months, the number of periods, it's going to be 60 of them. Payment, which is going to be that 1359. We've got the interest, the rent on us getting the money, and the loan reduction, the decrease and the loan amount for each payment, and the loan balance, what the balance will be after the loan reduction amount. Let's go ahead and make these our header kind of styli, selecting these columns, font group, We're going to make it black and white, as is our header custom alignment and center. Then we'll put the number of months starting at 0, 1, 2, copying that down to 60 with the good old autofill feature, selecting those three, fill handle, dragging it on down to 60 months. You get the little number right there, which makes it much easier to do, which is great. Little feature that Excel has. Let's center those items. Let's center them. And there we have it. I'm going to start off at period 0 with just the loan amount, which is going to be that 72,000. And then we will pick up the payment. So the payment's just going to simply equal that, about 1359. The interest calculation is going to be equal to the prior loan balance times the interest rate. That's the yearly rate though, so divided by 12 to give us the monthly interest. Subtracting out now, we get the 1359 minus the 300. That's the loan reduction. So the loan was at 72,000 minus the loan reduction of the 1059 gets us to the 70,941. Let's do it 2 more times, and then we'll copy it down and think about any changes we need to do to make it copied down as easy as possible. Let's do it again. The payment is still going to be the 1359. That doesn't change. The interest and loan reduction will change. Now we have a reduced balance of the 70,941 times the rate of 5%. That's the yearly rate divided by 12 to get the monthly amount. Then we're going to subtract this out. The 1359 minus the 296 gives us the loan reduction. Now we have the prior balance minus the loan reduction, bringing us down to the 69878. Let's do it one more time. We've got the 1359. We got the interest, which is going to be the 69878 times the interest rate, 5% for the yearly rate divided by 12 for the monthly rate. Loan reduction is going to be equal to the payment minus the interest. Loan balance then is the prior balance minus the loan reduction, and so on and so forth. So you can see the complexity when we do the journal entry is that the payment remains the same, but the breakout between the interest and principals differs, making an added level and wrinkle of complication when we put this into accounting software, because we would like to standardize the payment, making it, a set payment. We can't do that as easily because of the structure of a normal kind of loan balance. Now, if I was to copy this down, if I was to take these and say, what if I copy this down? I'm just going to do it to one cell. Does it work? No. Why not? Because this one moved down and the interest moved down. So that doesn't work. So I'm going to undo this and undo this and undo this. The general rule is that anything that's being picked up from our data set on the left, let's put a border around that while I'm over here, is going to be something that needs to be an absolute reference, meaning we need to tell the system, don't move the cell reference down relative when you copy it down. And anything that's in my actual data set over here that I'm building will generally need to be copied down as we copy it down, and we don't need to do anything to that, making it absolute, for example. So for example, this payment is coming from my data set on the left. So I don't want it to move down, so I'm going to make it absolute by pushing F4 on the keyboard, or $ before the ER, $ before the 5. You only need a mixed reference, but an absolute reference is easy, so I'm just going to use that one to do. And then the interest, double clicking on that, I can see that 5%. That's outside my what I'm building over here. So it's an ER, column ER. So that one that's in ER needs an absolute. F4 on the keyboard puts a $ before the ER, $ before the 4. Those $ having nothing to do with actually dollars. It's just a code for Excel to say, don't move that cell down, please. And then this one, nothing is outside of what I'm building. Therefore, general rule, I want those cells to move down relative when I copy them down. Double clicking this one, nothing is outside what I'm building. Therefore, general rule, I do want those to copy down. So now I'm going to select those 4 cells again, put my cursor on the fill handle, drag it all the way down. You could double click on it, but I'm just going to drag it because I want to be down here at the bottom where it will end and hopefully be 0. If it's 0 at the end, that's a good indication that we have done this properly. And you can see then that basically the interest portion of our payment is going to go down. The principal portion of our payment is going to go up as the payment basically remains the same. The payment will remain the same. The interest will be higher up front because the loan balance is higher. We're in essence renting more money up front as the loan balance goes down, the interest goes down. Because the payment is the same as the interest portion goes down, the loan reduction portion of the payment goes up, and so on as we go down to 0, and we see an extreme difference in terms of the interest portion being much smaller given about the fact that the loan balance is much smaller and the principal portion therefore much larger at the tail end of the loan. Let's do our formatting here. Let's make this blue for our data input type of stuff. I'll make this blue and bordered. Blue and bordered. If you don't have that blue, it's in the more colors area. The Excel is fun blue. Excel is fun guy blue. Okay, there we have that. And then I don't need this EY column. I'm going to put my cursor on it, right click, and just delete it. So we don't need that. And then this one could be a little skinnier maybe. That looks pretty good. So now we're going to record the transaction next time based on this amortization table. Now, sometimes the loan company would give you the amortization table. Sometimes they don't. You might work with a CPA firm to help you give you the amortization table. And we'll talk next time a little bit about how you might set up your payments if you're working with like an adjusting department at the end of the period and so on. You have different variations that you can use to basically set up the payments. But if you want to be breaking out the interest and principal, as we will be doing when making the payments, you will typically need the amortization table. If you don't get it from the institution, you could make one. You can have your CPA firm make one possibly as well to help you out with the process.